Did you know you can legally reduce your income tax while building more for retirement at the same time? Today I want to explain something called before tax contributions to super. It sounds technical, but once you understand the mechanics, it's actually quite straightforward. And if you use it properly, it can quietly improve your long-term retirement outcome without doing anything extreme. Before we get started, just a quick note. This video is general information only and doesn't take into account your personal circumstances. This is one of those areas where the rules work in your favour, if you understand them. A lot of people have heard the term salary sacrifice or concessional contributions, but they're not quite sure what it actually means. So let's strip it back, step by step. At its simplest, a before tax contribution is money that goes into your super before your normal tax is applied. That's it. Normally when you earn income, it flows like this. You earn money, tax is taken out, the rest lands in your bank account. With before tax contribution, part of your income takes a different path. Instead of going into your bank account first, it goes directly into your super fund. And inside super, it's taxed at 15% for most people. That 15% rate is the key. There are three main types of before tax contributions: your employer's compulsory super contributions, salary sacrifice, where you choose to send extra from your pay into super, and personal deductible contributions, where you contribute your own money and later claim a tax deduction. For today, the concept is the same for all three. The money goes into super before being taxed at your marginal tax rate, and instead it's taxed at 15% inside the fund. There is an annual limit called the concessional contribution cap, and that includes what your employer already contributes. So this isn't unlimited. But within the rules, it can be very effective. Let's make this practical. Imagine you earn $100. If you take that $100 as a normal income, you might pay, depending on your tax bracket, 30% or more in tax. So you don't get that full $100 to invest. Now imagine that same $100 goes into your super as a before tax contribution. Instead of being taxed at your marginal tax rate, it's taxed at 15%. That means more of that $100 stays invested. You haven't taken on more risk. You haven't done anything aggressive. You simply change the order in which the money is taxed. And over time, that difference compounds. Why does this matter? First, the tax rate. For most working Australians, the marginal tax rate is higher than 15%. That gap is effectively the benefit. It means more of your income stays invested rather than going to tax. If you're on a higher income, the difference can be meaningful. If you're on a lower income, the benefit may be smaller. So it's important to check. This isn't automatic for everyone. It depends on your situation. Second is time. If slightly more money goes into super each year, and that money stays invested for 20 or 30 years, the difference builds. It's not dramatic overnight. It's quiet, it's steady, but over decades, it adds up. Especially for people in their 30s, 40s, and 50s, who still have working years ahead. Third, structure. Salary sacrifice in particular creates discipline. It happens automatically. The money never hits your everyday account. So you're not relying on willpower. It builds retirement savings in the background. For many people, that system alone is powerful. Now, a few things to watch. There is an annual concessional contribution cap. That cap includes your employer contributions. If you exceed it, there can be additional tax and administrative complexity. So you need to know what's already going in before you add more. Cash flow matters. Money inside your super is generally locked away until you reach preservation age and meet a condition of release. So if you salary sacrifice too much income, you might create pressure in your day-to-day finances. Super is a long-term vehicle. You still need accessible savings outside super for flexibility. And finally, it doesn't suit everyone equally. If your marginal tax rate is close to 15%, the benefit is smaller. For some lower income earners, other strategies may be more appropriate. This is not about blindly maximising super, it's about using it deliberately. A few common mistakes I see is not checking how much your employer is already contributing, forgetting to include bonuses, setting a salary sacrifice once and never reviewing it, or locking away too much and later needing access to the money. These are avoidable with a bit of planning. If you're thinking this might be useful, here are some practical steps. Log into your super fund and check how much has been contributed so far this financial year. Confirm your marginal tax rate. Check the current concessional contribution cap. If you're employed, ask payroll how salary sacrifice works. Start small if needed, even $50 or $100 per week. Review your cash flow before increasing it. Track contributions during the year and reassess annually. Keep it controlled, keep it deliberate. Before tax contributions are simply a way of redirecting part of your income into super before it's taxed at your normal rate. For many Australians, that means paying less tax now and investing more for retirement. It's not complicated, it's not aggressive, it's just using the rules properly. And when it fits your broader plan, it can make it a meaningful difference over time. If you want to implement this properly, I help Australians structure this every day. Details are below.